Last week, we brought you detailed information on whole life insurance companies and products for high cash value designs. This week, it's all about the IULs. There's a lot of products out there, some good, some not so good. We're going to go over what you need to know if you're in the market for one of these products. Welcome to the Life Insurance Financial Education Podcast. We're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
My name's Jing with Tax Exempt Millionaire Club.
And my name is Carlo Viqueira with Net Wealth Finance.
And this is all about the IUL. Let's kick it off. Tell me a little bit about the top IUL products in your guys' mind right now. Keep in mind, this is as of this recording. Products are constantly changing and evolving. Carriers are offering new ones, new index options. So this information for today will be as of March of 2025. To kick us off, give me the top carriers that you guys like to use with one good reason that they're your top choice or top choices.
I like Allianz product. That's also the policy I own for my IUL policy. And I like their reputation, and then they are focused on one product as the IUL. I also like National Life. They give out a lot of living benefits to policyholders.
So I will say that Allianz is also my top choice. It is the IUL that I currently own. The reason why I like Allianz is if you get into very high funding levels, it's generally probably going to have the top performance. They have great index options, and I think that makes it a great product. For lower funding levels, I think National Life is a really strong carrier due to the ability to get to a very low base and even being able to blend at that low funding level. And then for other purposes, diversification and things like that, I might look to F&G or Securian. I think they have some pretty decent index options. And specifically on the F&G side, I would say they have a really good loan structure that is a variable rate, but they just cap that rate at 5%. So that's a really good advantage of that product.
All right. And for me, very similar, probably not a surprise as we talk about these things regularly, but Allianz tends to be the top product among my clients, mostly because the blended design allows us to have a very, very low expense with the ability to dump a ton of cash inside it. And the index options are amazing. On the lower level, National Life works really good for people that want to fund at like $50 a month, $100 a month. Like we can actually grow cash value at that lower level when we can do a blended design with National Life. And for those in between, Securian ends up being a good diversification and really good index options to choose from. I'm going to be diving into the details on a lot of the other products and why they didn't pop up in like the top choices of what we've done. It doesn't mean that if you own a product of one of these other carriers that it's not going to work. There is a possibility that all of them could be successful. How we like to approach things is what gives us the highest likelihood of success. And generally that involves some type of a blended design that allows us to reduce the expenses, because some of these products, the expenses can really get out of control. And it could really lead to poor overall performance, even if you're getting high interest credits from your index options that you're able to get. Sometimes it's just not enough to overcome the expenses.
Yes. So one other thing to keep in mind is some of these carriers have good living benefits riders, and that can be a consideration. And some of these carriers and products have good convertible term options. So depending on what those circumstances are for you, those might be things you want to consider. Maybe you want to get a policy in force that is just a term policy for now, but you possibly want to change that into a high cash value policy later.
Good points. Not everybody's going to be buying these products just for the cash growth purposes. There could be some competing interests, such as having access to those living benefit riders, which act very much like, I like to call it pseudo long-term care policies. It's not a long-term care policy, but they're offered free of charge, and it gives you access to more than just the cash value in the event that you qualify for certain living benefits. So you can access more than the cash value before you actually die.
I think the living benefit is actually very, very attractive for a lot of people, especially right now. People all know the long-term care costs can be outrageously high. I think if we could have that mindset to utilize this policy as one of the pseudo long-term care, that could be one of the really good benefit for a lot of people.
And in that line, Jing mentioned it earlier, National Life has the best living benefit riders in the IUL space, and they actually offer it on their term product as well. And their term product has really good conversion options, which allows us to convert to the permanent IUL product and do a nice blended design that allows us to reduce the expenses. So this is where that particular product shines, and I tend to find my clients choose that product when we're funding it at the low level, and or they're wanting access to better living benefit options or a good term with convertibility.
So would you say, I think I agree, National Life, great carrier for that convertible term. Are there other carriers? If you have a client who's really looking for a term policy for now and looking to convert later, what are your thoughts on that? If maybe National Life doesn't give a good offer or whatever it might be, that you don't end up going with National Life since that is the best option?
That's a good question. I generally don't do a whole lot of term insurance. When it comes to the convertibility, National Life is the top choice for me. Allianz doesn't even sell term insurance. So Allianz, it's not a choice if we're looking to get term now and convert it later. It's important if we're shopping for term that has conversions and we're thinking of having the ability to convert later, that we can convert it into a good product that we actually want to own. I don't generally get too far into much of the other products. Transamerica has a term product. It can be converted, but only into a whole life policy for Transamerica. And we can't do any type of a blended design. That one doesn't really meet the bill or a product we would necessarily want to convert into. Other carriers have similar limitations, or it might just be a product that we can't do any type of a blended design. So that is something to keep in mind. If for some reason you can't qualify for the National Life product, we're probably going to have to really look into what are the odds that you're going to need to convert down the road, and how do we fit that into your overall plan? Because I think the options tend to get fairly limited in the IUL space. Maybe we look at whole life in that scenario.
One of our friends was really just looking for a term policy, but whenever we do end up selling a term policy, we like to pay attention and let them know if there is any interest in possibly converting. If there's a small difference, $50 a year, going with a product that is at least convertible and has decent convertible options could be the way to go. So we did end up landing on Pacific Life. It had the name recognition to this particular client, and that is one thing that we chose. I think it's an okay product for that purpose, and just in that particular circumstance, we didn't go with National Life, and so that was sort of an option that came to our minds, and I think it's an okay product in terms of the IUL that they offer.
Pacific Life does offer some term. Some of it is not convertible, so be aware of that. And their IUL is generally one of the top selling IULs out there. So having the ability to convert into that, it's a little bit of a challenge when it comes to designs. I know a lot of Pacific Life agents are captive agents, and they generally don't do a type of blended design, but you can do a blended design with their IUL. I don't know if you can blend it with their convertible term. So something to keep in mind. Generally, having access to the living benefit riders that National Life offers with the term product and having the convertibility really puts that National Life term product at the top of the list for me. So I'm usually not looking at the other products outside of that one. And the cost is very similar to any other convertible term product.
So James, let me ask you, just pretend I'm a new client. I want to shop for IUL. And how will you guide your client to think about which product from which company will be best suitable for my situation?
Great question. Generally, the first thing that we want to look at is funding level. That's really what breaks down the different tiers in products. If we're going to fund at a really high level, I'm always going to show an Allianz illustration. We're going to look and see what the numbers look like there. At the low level, Allianz doesn't make a lot of sense for a lot of people because it's a higher expense product if we're not getting into the blended designs. But once you get to the blended designs, that's when everything kind of comes together for that product. We get lower overall expenses, really good growth potential because their index options are top of the line, and it just ends up being a very good product long term. Outside of that, if it's a lower funding level, we're going to be looking at some other products that offer a better value at that lower funding level. Like I said earlier, if you're going to be contributing like $50 a month or $100 a month, the higher base that's required in most of the products out there makes it a no-go. Like you can't even consider it if you want to grow cash value. So funding level is like the first determining factor when it comes to trying to decide what products might we even look towards for your situation. And ultimately, we're going to probably want to look at multiple products anyways, regardless of your funding level, just so that you can see the numbers. Everything that we do is so transparent, and we put in so much detail that clients that are researching this stuff should be able to walk away with as much information as they need to be able to make a decision between the different products.
We could also think about purchasing multiple policies for different purposes in that case as well.
And there are times where I'll have clients that are looking to cover multiple people, and they want the diversification of using different products because it gives us access to different indexes, maybe different types of annual point-to-points where we can do some dollar cost averaging, or we have a lock feature. So there's a number of reasons why we might end up using a couple of different products within the same family.
That's great to know. Thank you so much.
Yeah, I think that the diversification with these, if you are getting into the higher funding levels and or maybe having multiple policies for different people in your family, I think it is a good option to possibly look at a couple of different carriers for the different people. Because when you're looking at these indexing strategies within each IUL, some might perform better in some years or some type of interest rate or market environments, and some might perform better in others. So generally speaking, Allianz is very strong, and especially with their new product, it's extremely strong. I have high confidence in them continuing to be strong, but I do still think looking at some of these other carriers can be a good tool to have in the toolkit for if you're having multiple policies in your family.
And with that said, for the last couple of years, I've done a video on all the top IUL products. I have a spreadsheet that I've created that tracks most of the differences between these top products, things that you need to know as a consumer to help you decide between one or the other. I haven't updated it yet for 2025, but it's coming soon. So if you want to see all the different details, we're going to touch on them a little bit today. But if you want to go see that, you got to get to my channel and look up top IUL products compared. And you'll get a lot of insight because that's a much longer video that goes into a lot of specific detail. With that said, let's touch on some of these top products. I'm going to highlight some of the key differences, and Jing or Carlo may have a few questions about any of these particular products. And we're going to end by going into some specific detail. And we'll try and finish up with anything that might have been missed in all those little details. So kicking us off, the main thing to know when we're talking high cash value designs is what type of a blend does each of these carriers offer. Some of them offer a really good blend, some of them offer a very low blend, and some of them offer no blend. In your head, when we say high blended design, think low expenses. And when we say no blend, think high expenses. That's generally how it works out. So Allianz and Transamerica both clock in with a 10-to-1 blend on their IUL product. 10-to-1 means we can have a very low base with a maximum amount of supplemental term blended in that doesn't pay anybody a commission, and we get a ton of mech space in that type of a product. Those are the only two that give us that 10-to-1 design. Next level is going to be F&G, clocking in at 9-to-1. Then we have Securian and Penn Mutual at a 4-to-1 blend, and National Life at a 3-to-1 blend. Most of your other carriers, there's no blend available. North American, there's no blend. Nationwide and Mutual of Omaha, there's no blend, and there's two that I actually missed in that list. Symetra gives us a 4-to-1 blend, and Pacific Life offers a 5-to-1 blend. So good luck finding an agent that will actually do that blended design with the Pacific Life product.
So I do want to dig in and highlight something on the Allianz side, and that is, I believe it's age 50 when that blend will drop to a 5-to-1. Correct me if I'm wrong on that. So that is something to consider if you're over age 50, that you might not have access to that perfectly optimized 10-to-1 blend. Are there any other carriers that are also in that boat?
So, good thing to know. With Allianz, it's actually under 18 or over 50. You're going to be limited to that 5-to-1 blend. The only other one in my mind is F&G. F&G stands for Fidelity and Guarantee Life. They don't offer a split design for juveniles. So when it comes to a good juvenile policy, I generally don't even consider F&G if we're looking to contribute a lot of funds to it, because we can't do any type of a blend. But the other thing to consider with F&G, this is going to get a little bit nuanced. But after age 45, you can start the blend with F&G at a $50,000 base. Normally, F&G, you can't start that blend unless you have more than $150,000 in base face amount. Allianz is $100,000, Securian is $100,000, Transamerica is $100,000. So those are all like the minimum base amounts before we can start to blend. And then some of these other carriers, they will allow us to start with a lower base face amount, but then they don't offer the blend. So a lot of little nuances here among the different products, which is why it's important that you're talking to agents that understand these things and know the ins and outs of these products.
I do want to call out, it was, I think, previously mentioned that National Life has that low blend, but that is one of the advantages, that $25,000 blend base, and being able to blend that with $75,000 in term to have a total of $100,000. So that is always, I think, the lowest, but it sounds like F&G gets close to that at age 45 with that 50,000 base.
Correct. And National Life, you can actually do a 25 base and 25 blend. So we can have a minimum of 50,000 with National Life, which is why that product ends up being generally the top choice at that very low funding level. Whereas F&G could also be good after age 45, getting that blend in there. Next, comparing among all of these different products, let's talk Target Premium. Target Premium is a direct reflection of the expenses in the policy. It tells the insurance company what they need to know for how much to recoup based on commissions, medical underwriting, ordering medical exams, anything it took to sell you that product. So it's always important to know, where's that target premium going to be at? This is where the blended designs really shine. I'm going to use an example of a 40-year-old male. With a 40-year-old male, and if we're doing $1 million or a maximum blend, whichever one ends up being higher, how do each of these products compare for target premium? With Allianz, it clocks in just under $3,000. With F&G, we're just over $3,000. So very similar there. With Pacific Life, we're going to be just over $4,000. With National Life, we're just over $4,000. With North American, we're just under $10,000. Securian, just under $4,000. Penn Mutual, we're now over $8,000. Transamerica clocks in at the lowest with one of their products. They have two IULs. One of theirs clocks in at just under $2,000. And their other one clocks in at just over $6,000. Mutual of Omaha, you're going to be pushing over $8,000. And Nationwide, just under $4,000. So we got kind of a mix there where we've got a really high, just under $10,000 at the high level for $1 million and just under $2,000 with the proper blended designs. Now, what's wild is if we didn't do a blended designs, I think you're probably going to see these commissions top out over $20,000 for that same $1 million death benefit. So there can be a huge discrepancy when it comes to expenses inside these policies.
Yes, and I think that's really a big thing to consider. So what James walked through this sort of industry term, target premium, talked about it recouping expenses. And what all of that means is that's what impacts your cash value, especially in those early years. And when you impact the cash value in those early years, this thing called compound interest will compound over the years and result in drastic cash value differences. So that's why it's a very important thing, and why it's a big focus for us in this policy is minimizing those early expenses and expenses in general to make sure that our clients have the most money in their pocket with these policies.
It is also super important because, like what James mentioned, the numbers all the way from 2,000 to 10,000. It's super important for the client to talk to someone who can be independently represent all different carriers instead of just talking to the captive agents.
Absolutely. Now, I think it's important to mention, I've talked about the Transamerica product as being equal to Allianz for blended design. At least one of their IULs is equal to Allianz from a blended design standpoint. And what you just heard is it comes with a lower target premium at that maximum blend as well. So why did that product not make it into any of the top 3 that we talked about earlier on?
Well, I think one of the main considerations there is they have this asset charge that is not optional, I believe.
Correct. That is one of the reasons why Transamerica doesn't make it to the top. Some carriers have an asset charge or an account value charge. So the more money you put into these accounts, the greater the expense is going to be. And if we're going to own these products for 30, 40, 50 plus years, we're going to be getting a lot of money into these, and those expenses can really add up. Allianz doesn't have an account value charge. F&G doesn't have an account value charge. Securian doesn't have an account value charge, although they reserve the ability to add one in the future. And National Life has a very small account value charge, only for 25 years. But remember, the National Life product, we're generally using that one at the low funding level. That account value charge doesn't really add up to very much in that product, and it's a low expense product in general, so it almost doesn't have that much impact. The other thing with Transamerica is the loan options. Remember, they have 2 IULs. In one of them, you cannot get a participating index loan. So if you're going to be putting a lot of money into the policy and borrowing from it, you're going to be stunting the growth. You're going to be limited to a 2% growth in the event that you're taking out a loan. That doesn't work for a lot of people. I can envision the scenario where that might work if somebody just looks at it like a possible retirement product. You're going to put in your money. You're not going to touch it. It has a very low expense design, and it could work well if you're not planning on borrowing against it. Once you get into retirement, I guess you could borrow against it at that point. You still don't have the opportunity to earn any arbitrage by using those participating index loans that we like to use, but maybe you got some good growth out of it.
Yes, and that's one of the main reasons why I lean on my own IUL, that participating index loan. My IUL is the first place that I'm going to tap for funds because I know I can borrow against it at a good rate. So my Allianz policy, I can borrow at 5%. And this past year, I think my average credit between the different indexing strategies was somewhere around 7%. This is not, projecting forward, a guarantee of return for you and your circumstances, but that's just an example. I had a year of positive arbitrage on those borrowed funds, and that's a really big advantage. I earned 2% on borrowed funds, and that's what makes these products really amazing for our purposes.
I think that's one of the most attractive features of the IULs, the ability to potentially earn arbitrage on funds that we've got deployed elsewhere, earning us, hopefully, other money in investments as well. Now, I mentioned Transamerica has 2 products. Their second product is the newer one. It got a lot better in some aspects, but it got worse in other aspects for some of the things that we're trying to do. They did offer a participating index loan in that other product, but the target premium went way up. It doesn't have the low expenses of the other product design. They did away with the asset charge, so a little lower expense in that regard. But when it comes to doing the blended design, there's a massive impact on the load fees for that product. Their other product, the one that I like that has the low cost but not a good borrowing option, that product has really low load fees to go along with it. Well, with the new product, if you fund above target premium, you're going to get hit with a 14% load fee above target premium. Now, when we do our blended designs, we're trying to minimize that target premium. So if we get that premium nice and low, if we get that target premium nice and low, in order to save you, the client, a bunch of money on commissions, you're just going to pay a bunch of money to the insurance company on excess load fees instead. So while I'm trying to do a good job as an agent and reduce what I'm going to make on it, they're turning around and charging you more for some reason. I don't know why they did that, but it essentially makes that product a no-go for the types of designs that we're doing. You essentially need to fund at target premium to be able to take advantage of what would be a load fee very similar to Allianz load fees, but you're paying out a high target premium. Like, make it make sense. It doesn't to me. I don't really sell this product.
To put some numbers to it, I think we have to call out. So Allianz has the 5% load fee, which is a really great load fee. And I will say also, though, that is these load fees for any of these IULs, it is a downside when you compare it to something like that is a direct market investment in general. That is money that comes off the top when you put these into this policy. It's kind of what you're doing to buy that floor in these IULs. And I think it is just part of the territory for an IUL. But we want to have products that have lower load fees in order to ensure we can have the best cash growth possible.
Yeah, a typical load fee is going to be somewhere between 4 and 8%, with our top products offering 5 and 6%, somewhere between 5 and 6% as a normal load fee. It's a one-time cost. Once you get that money in there, it has the opportunity to grow and compound for the rest of your life. So it's not that big of a deal to have that one-time cost just to get the money in. An insurance company has to pay taxes and sometimes a little bit of compensation to the agent when you put money into the product. So that's what that load fee goes for. So there's a reason for it. It's not like you're just paying it for no reason.
Well, and I like to think about it in terms of I'm buying that 0% or whatever that floor is in these products. And that's how I like to think about that load fee. It is that one-time cost, and it's not going to be like that for the future when the compounding continues throughout the life of that policy.
And also remember, we're still buying a life insurance. So don't be afraid of all kinds of fees because it's a life insurance policy. So the carrier has to tolerate a lot of different fees. But we are targeting the high growth of the cash value. We can really let the cash value grow inside of our policies.
Yeah, but we got to do what we can to keep those fees to a minimum. And some products are just better than others when it comes to allowing that to happen. Outside of the expenses in the policy, let's wrap up the discussion on these different products with the index options. Because the reason people are getting into this is the ability to grow that cash. How I like to position the IUL is a safe place to get market-like returns or good potential growth with downside protection. 0% is generally a floor, although some products have bonuses that makes that floor higher than 0%. But the key is getting that upward growth. So there are going to be some products that have very low caps. Some products have high caps. Some index options inside of these products might be uncapped. What do you guys like out there?
I think one of the best reasons or the biggest reasons why Allianz is my favorite product is those index options, specifically the uncapped options. With Allianz now offering this S&P futures index option that is uncapped, it is an amazing option if you want to have some tracking that might be kind of similar to the S&P 500. They also have great other uncapped options. Specifically, the PIMCO has done really well for me over the past 2 years. The other feature that I really like within that Allianz product is the ability to lock, both a downside lock or an upside target. I think that's a really good option for the Allianz IUL.
Yeah, for me, the same as what Carlo mentioned, the SP 500 as well as the PIMCO. And then I should pay attention, do some asset allocation to the indexes. I did not have much time to do it, but their performance of both index are pretty good.
So between all of these products, there's a number of volatility indexes. There's a number of products that have exposure to the S&P 500. Some of them have exposure to like the NASDAQ 100. You get a lot of good different choices here. And I think that's where the value lies inside of these products. People like the idea of having exposure to these indexes without exposure to the downside. That's where these get positioned. Like I talk to a lot of people who have a lot of investments in the market, but when you're actually in the market, you don't have any of that downside protection. So having that downside protection, but exposure to the indexes that you like is great. Now, in general, we like having uncapped exposure, but pretty much every carrier has a capped S&P option. It tends to be like the backbone of what most IUL offer. Those caps, I've seen them range from about 7% up to 12.5% over the last year. So there could be a pretty wide range in which products allow you to get good growth. If you're in a product that has a 7% cap, it's going to be really hard for you to get an average growth that's probably higher than 5% over the long term. Whereas if you can get a 12.5% cap, the ability for you to get above that 6% average that we like to illustrate at greatly increases if you're using the S&P capped option. Now, the Allianz, the reason we like that one, uncapped S&P futures option, gives us incredible exposure to the S&P. There are some other carriers that offer similar things to that. So I definitely think that when people are shopping for these, you're going to want to take a look at the index options. Some products just don't give you the ability to get growth that other products do based on the index options or the cap rates or participation rates that they offer within those products.
Yeah. So one other thing that some carriers might offer is the concept of a trigger. For example, if the S&P does 1% in a given year and the product has an index option for trigger and you select that, you might get credited 8% because it is above zero. As long as it has a gain of some sort, your trigger rate gets triggered. So that is a nice thing. If you really think that it's going to be a volatile market and maybe a low returning year, that might be a good option to lock in a pretty decent return for that year.
Yeah, the trigger rate is a good one for a hedge. If you're not sure what the market's going to return, there's nothing wrong with getting an 8% or 8.25%, I think I've seen on trigger rates. There's nothing wrong with getting that in a sideways to down market. And if the cap rate of a product is 11% or 12%, and it happens to cap out, but you got 8.25%, it's not that big of a deal. You're still probably pretty happy at getting the 8.25%. Well, let's finish up with a mention about the fixed interest accounts with these products. I think this is important. The fixed interest accounts, to me, represent the amount of budget that a carrier is going to put towards the index options for you. Because you can either put your money into the index options or just take the fixed rate that they're offering. And there is a wide range of fixed rate options out there. Some carriers end up down around 3%, while our top carriers over 5%. In fact, I say carriers, but there really isn't many, if any, other carriers besides Allianz. That's at like 5.2, 5.3, 5.4% right now for their fixed interest option. And the reason behind that is because Allianz doesn't profit off of their index options. So they say, we don't care. Take the fixed rate. It's going to be nice and high, or use the index options. Either one, not a big deal to them. But some other carriers do profit off of those index options. And so they're going to offer you a lower fixed rate because they want you to choose the index options. It ends up being better for their bottom line if you're utilizing the index options as opposed to the fixed rate.
And one of the ways that Allianz can not need to profit off of that as well is their costs are lower by virtue of having in-house trading for those. So I think that, as I understand it, I don't think most carriers have that in-house trading to be able to allow for that minimal costs on those index options.
Yeah, Allianz has saved more than $2 billion over the last decade and a half by bringing that in-house. They do their own trade desk. Most carriers will outsource that. And so there's a cost to that. And also, it comes with other limitations. The reason Allianz is able to offer that lock feature is because they're in the market every single day. If you put in a lock request, it goes right to their trade desk and they can lock it in at the end of the day. Other carriers, they're not able to do that. They have sweeps periods where they're going to bundle up all the money that came in and then they're going to go send it to the people who are going to buy their index options once a month. Kind of interesting how these things differ among the different carriers. All of these details do play a part in how your expenses are going to add up in these products and your growth potential. I think this is a good place to wrap this up. We went into a ton of detail. You're probably going to want to listen to this a couple of times. What would you guys say is a good call to action for our folks this week?
It's time for this week's call to action.
I would encourage every one of you to really drill down a little bit and then really talk to an independent life insurance agent to map out different options, different products, different features, and to take a look. If you put this amount of money down, what's your purpose? What's your plan? How long you plan to fund it? Do you want to take the loan option? Really have the holistic picture when you go talk to someone. And don't be afraid of looking at all the numbers, because those numbers will correlate to how much money you can accumulate inside of your policy.
I would also add that I think I've said this in a couple of episodes, one of the things that both whole life and IUL does for me is it allows for me to increase my savings rate because I don't lose access to the funds. So if you knew that you had the option with something like a participating index loan to be able to tap the funds if you need to in emergency or for investing in things if you want to, what would your savings rate be? Could you increase your savings rate? That, I think, is one of the most powerful things for achieving financial independence. So maybe assess your finances and see if you could increase your savings rate if you knew you wouldn't completely lose access to those funds.
And I would say take a look at where the IUL might fit in your overall financial plan with what it offers from downside protection. What is the risk that you currently have with exposure to the market and the amount of funds that you have invested when the market goes down? At what level would you feel better having funds that weren't exposed to that downside? This is the key aspect of the IUL, what we get from that downside protection. So assess your overall finances. Obviously, you could talk to an insurance professional to help you determine where this might fit in your overall financial plan. And then, of course, which product has the best designs available to match that need. With that, thank you for joining us this week. Next week, we're going to touch on VULs, variable universal life insurance. Something we don't talk about very often, but it's an option for people out there. Is it a good place to store high cash value? Find out more next week. With that, I'm James Barber, your Oregon Cash Flow Pro. I'm licensed to do life insurance and annuities across the country.
My name's Jane, your host of Tech Exempt Millionaire Club. Our mission is to really help you accumulate tax-free millions of dollars. I'm also licensed life insurance agent in multiple states, ready to help you assist your financial future.
And my name is Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we work with clients across the country as well.
Take care. We'll see you next time.
Thank you. See you next time.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.